That is about the Indian rupee. For that, we are talking about the fall that we've seen and essentially what the future could bring. We are being joined in this discussion by Kunal Sodhani. He's the Vice President, Global Trading Center at Shinhan Bank, and Madhavi Arora is Lead Economist at Emkay Global. Coming to you first, Madhavi, at current levels, I wanted to ask if the Indian rupee is still overvalued and if the RBI should allow it to find its own level, because that's definitely one contention.
Clearly, at this point in time, the way the rupee has sort of held up against its own peers, I think that is more important than sort of looking at rupee in absolute terms against the dollar, because it's a lot of noise in the background. Can you ask your at the moment?
Come to you in a moment because there is a lot of disturbance in the area that you're in. But Kunal, can I just quickly ask you, because you track the markets very closely, I'm just wondering, with the kind of fall that we've seen in the Indian rupee, how are investors hedging their risks in recent times against this falling rupee? What are the most eye-catching trends you've spotted in the sectoral shifts perhaps, and in kind of trends that you're seeing at a time that the rupee has launched that downward spiral and it's just been going down? Is it different from trends that you've noticed in the past when the rupee has taken a fall?
So definitely yes. Particularly when I talk about importers, I have seen a lot of shift in terms of mindset, because usually when I talk about importers, they shy away from hedging their exposure. But off lately, they have started understanding options as a product, because it gives a double P approach, a participation as well as a protection approach, wherein they are even hedged, and at least they can even participate if levels move lower towards maybe 80 odd levels. So it gives a double-edged advantage to the importers. While on the other hand, speaking to the exporters, we have got to understand that they have started hedging themselves at staggered manner, not trying to eye the top or to eye any particular level of 83, 84, but hedging in a staggered manner by converting their 3-month to 6-month exposure in several ratios like 30%, 20%, 40%. So they have been hedging in staggered manner, anticipating that obviously the move is on the right side, but that does not mean that we can be complacent enough and this move will continue. And as I said, with exporters, they are cautious and using options as a tool at this point in time, which remains favorable for them as well.
So also looking at the way the RBI has been moving and trying to cushion the fall of the Indian rupee, do you think it's something that they can continue doing as well? Because, sometimes you say that forex reserves are also important at a time that you're going to face a global recession, and it's important for the Reserve Bank to really hold back what they have. Do you think it makes sense for the RBI to really intervene as much as it has? And do you see them doing more of it as the rupee falls even further?
So basically, if we talk about the FX reserves, we have seen a drop from $643 billion to today's data, which came at $532 billion. So more than $100 billion of FX reserves is out. Now the point of contention is we are standing at a 9-month import cover. And to compromise this below by intervening or depleting more of FX reserves would be challenging for RBI. That's my personal opinion. Secondly, if we also see the liquidity conditions in the market, the more they intervene, the more they are sucking out of the liquidity from the market, which is already less in nature at the current juncture. So I think intervention may be there, maybe at interims, but I do not anticipate any kind of strong or aggressive intervention at this point in time, because if you see the oil prices also, which is bouncing back towards $96 per barrel Brent, which is obviously going to put more pressure on current account deficit and the balance of payments. And if we are depleting forex reserves, we need to borrow more dollars to fund them, which will be furthermore taxing and a spiral effect on the rupee. So I think they may intervene only in interims. I don't see or forecast any sharp intervention at this point in time.
All right, let me find out if we've resumed our connection with Madhavi Arora and whether it's clear this time around. Madhavi, can you hear us well?
Yes, I can hear you well.
Oh, great. So, Madhavi, just what I was asking, because now you're seeing this current account deficit already ballooning, where we're importing more than what we're exporting. Declining Indian rupee is likely to make imports that much more expensive. And with our biggest import bill being crude oil, something that Mr. Sodhani was also pointing out, and crude oil prices being on the rise again, how much more pressure do you think it's going to bring upon the rupee going ahead, and will that significantly stall growth in India?
So interestingly, India's story is, as we're talking about the India story being attacked decoupled because we're a domestic driven economy, that will also come at its cost because that will imply that your imports probably will grow faster than exports because exports obviously is a function of global demand. And that again would imply that your current account deficit is likely to remain, comfortably high as far as the policymakers, comfort zone is there. So we're looking at 3.5% plus on a current account deficit to GDP ratio, which and the deficit of close to around 67 billion, which clearly implies that there is further pressure on the rupee as we go ahead. And I was mentioning before as well, we seem to be quite fixated on the USD INR, being a pair to watch out for. But I think, when you're talking about trade competitiveness, what you need to see is how India has fared against its own Asian peers. Because if you intend to become an export, hub in the medium term, these are the countries that you're competing with in an immediate basis. And more importantly, against China, which has been depreciating since April early when they put a COVID restriction in order. Rupee has appreciated close to 7% against China since beginning of our fiscal year. And we have almost 40% of our trade deficit with China, which again implies that, we're looking at very high, regional imbalances, so to say. So I think while one is fixated towards how USD INR is performing or whether INR is better than other currencies, I think to the extent that we need to catch up against our peers, my sense is that $1 rally isn't over yet. Of course, we would not be seeing the kind of up move that we saw in the last 1 year in dollar to repeat. But I think, the euro and JPY play is still, impending, which will essentially, play in favor of US exceptionalism and could again put pressure on emerging market currencies. And my sense is that probably rupee this time around would be let go of by the Reserve Bank of India to be able to catch up with other emerging markets. My sense is that given the BOP focus that I'm having in my books, I think there is impending pressure on the rupee, and my sense the rupee should ideally probably fall another 2 rupees or so from here on.
How much of a liquidity concern do we have right now? Because in recent times, we've talked about credit growth, and that has kind of as a high frequency indicator, it has really done well for itself. But at the same time, we're not seeing so much of capex take place. So if you're trying to sustain growth, you need all these parameters to keep working. If one of them gives up, then we don't have that all-round growth. Now, that is going to take a beating, but how much is the question? And at a time when there is weakness in the Indian rupee and you're seeing, weakness in metal prices, invariably we'll see the dollar index on the rise. We've seen that in our own markets where metals have come under pressure. In our bid to turn the weakness in the Chinese manufacturing growth into an opportunity for us, are we likely to miss that bus if we aren't able to, even source our metals from iron alloys, platinum, if you don't get them at decent prices because of the fall in the Indian rupee? Madhavi, that was for you. Madhavi?
Okay, so I think I'll take it. In the meantime, I think...
yes, I'll try and re-establish a connection with her. I don't think she's able to hear me correctly. Kunal,
sure. So no problem. I'll just go ahead. So I think if we talk about exports per se, just talking in a lay language where all the audience can also understand, what are our major exports? We have gems and jewelry, we have chemicals, on the import side, and many other export products we have. But I think if there is a supply bottleneck and the inflationary pressure remains, and the supply is less, the input cost will go higher. And if the input cost is going higher, it obviously impacts the overall export number at large, which again instills the fact that the current account deficit number will be under pressure. So we are only talking about imports at this point, but I think exports are also taking hit because the margins are also taking hit because of the higher import cost because of lesser supply at the current juncture.
Yes, that really helps to put in perspective exactly how this is likely to play out, especially on the import-export front. So more pressure on the Indian rupee, that's a given. I wish we had a stronger connection with Madhavi, but I'm afraid we'll have to wrap up this discussion at this point. But thanks very much, Kunal Sodhani and Madhavi, for joining us on this edition of India Tonight.